Welcome to The Explainer. Today, we're going to tackle a question that's right at the heart of our economy. How do banks actually create money? It's a process that starts with a really clean blueprint, but as we're about to see, it runs smack into a much messier reality. So let's kick things off with a question that honestly sounds a bit like a magic trick. How on earth can the banking system take a single dollar, or let's say $1,000, and spin that into $5,000 circulating in the economy? Well, it's not magic. It's actually by design. And the secret lies in a system called fractional reserve banking. Now, all that means is that banks only have to keep a fraction of the money you deposit with them. The rest of it, they get to lend it out. And that simple act of lending is what kicks off this whole incredible process of money creation. Okay, so first, let's start with the theory. We need to look at the perfect blueprint. You know, how this whole thing is supposed to work in a lab, with no complications whatsoever. This idea is called the deposit multiplier. And I want you to think of it as the absolute best case scenario, the theoretical maximum amount of money that could possibly be created if everything in the system goes exactly according to plan. So to really make this stick, let's follow the journey of a single $1,000 bill. And for our example, let's just say the government requires all banks to keep 20% of their deposits locked away in reserve. All right, here's how it goes. You deposit your $1,000. The bank holds on to $200 and lends out the other $800. Now, the person who borrows that money goes and spends it, and whoever they pay deposits that $800 into another bank. And then that bank does the exact same thing all over again. It's this amazing chain reaction that literally acts as the engine for creating new money. And you know, the math behind this whole thing is actually way simpler than you might think. To figure out the theoretical multiplier, you just take the number 1 and divide it by whatever the reserve requirement is. That's it. So in our example, with that 20% reserve ratio, the math is just 1 divided by 0.20, and that gives us a deposit multiplier of 5. Simple as that. So a 5x multiplier, what does that mean? It means our initial $1,000 can, in theory, create a grand total of $5,000 in new money across the entire banking system. 1,000 becomes 5. Pretty cool, right? And, you know, if banks were just perfect little machines that always loaned out every single dollar they could, and if every one of those dollars was instantly put right back into another bank, well, this would be a super neat and tidy story. We could just end it right here. But come on, we don't live in a textbook model, do we? We live in the real world, and in the real world, the decisions that actual people and actual banks make, well, they throw a few wrenches into the works and change the whole equation. So, let's get real. It is time for our reality check. Let's meet the deposit multiplier's more practical and frankly much more important sibling, the money multiplier. See, the money multiplier is what happens when you take our perfect blueprint and you toss it into the messiness of the real world. It shows us what actually happens to the money supply, not just what could happen in some perfect theoretical scenario. So here's the absolute key difference. The deposit multiplier is the blueprint. It's the theoretical ceiling, the absolute maximum. But the money multiplier, that's reality. It's the actual number, and it's always smaller because of these things that economists call leakages from the system. So let's talk about these leakages. And no, this isn't a plumbing problem, it's an economics one. Leakages are basically all the ways that money can drip out of that perfect circular flow of lending and redepositing we talked about. So you have to wonder, what are these things that keep the money creation machine from running at full throttle? Where does all that potential money go that stops the real multiplier from ever hitting that theoretical maximum? Well, it really boils down to 3 main culprits. First, banks don't always lend out every penny they can. Sometimes they get nervous and hold on to excess reserves just to be safe. Second, people might get a loan and then stick it in a savings account instead of a checking account. And third, and this one's huge, people take money out as physical cash, which yanks it out of the digital banking system altogether. And every single one of those actions, a bank playing it safe, you deciding to save a bit more, or even just pulling a 20 out of an ATM, every one of them shrinks the potential expansion of the money supply. And that's exactly why the money multiplier gives us a much more realistic picture of what's actually going on in the economy. Now, I know what you might be thinking. Okay, this is just some tiny little distinction that only economists argue about, right? Wrong. Understanding this gap between the blueprint and the reality, it has enormous consequences for every single one of us. And I mean it. This is not just some academic footnote. This gap is the difference between a predictable machine and a complex, living system. It influences everything from the interest rate on your car loan all the way up to the stability of the entire global economy. So, here's the bottom line. The people in charge, like the Federal Reserve, they can't just base their big policy decisions on that simple, perfect world deposit multiplier. No way. They have to work with the messy, unpredictable, real-world money multiplier to try and manage the actual money supply, influence interest rates, and hopefully keep the economy on a stable path. So ultimately, yeah, the deposit multiplier is a great tool for understanding the basic idea. It's kind of like the training wheels. But the money multiplier, that's the real deal. It's the tool that people in the real world use, not just the theorists. So think about the journey we've just been on. We started with this clean, simple formula, and we ended up in a much more complex reality. A reality that's driven not just by rules and ratios, but by the everyday choices of bankers, borrowers, and savers, people just like you and me. And all of this leaves us with one last, really big thought. The money multiplier shows us that creating money isn't just a mechanical process, it's a behavioral one. And if that's true, it raises a pretty profound question. In a world driven by unpredictable human choices, just how much control can we ever really have over the economy?